So this tutorial, I just kind of wanted to give a bit of a background as to why it's so important to really develop your skills um, in Excel when you're exporting your financial reports from your ERP system. Okay, so again, we really want to try to give you those types of skills and an introduction into these techniques that you can use into the workplace, and that you'll probably see is more common when you learn it for the first time. You'll see that it's something that happens all the time around you in business. It's especially if you're working in a mid to large size company. It's not very likely that you're just going to sit there and look at a copy of a financial statement that hasn't had some type of analysis added to it to increase the value of the information that's being presented. Okay, so I just kind of wanted to go through how you would get the information inside of our ERP system to start off with. So we're looking at NetSuite. So first off, you would go to your reports. Okay, you can go to financial, and if you want to grab your comparative balance sheet, give me one sec. Let me change companies. So what I'm going to pull up is the comparative balance sheet so that we can look at 2 years or 2 fiscal periods, because typically that's what companies are doing. It's fine and dandy if you're a small type company to look at what's going on solely in your current most recent fiscal period. But the larger you grow, the more important history becomes, the more important comparing from one period to the next becomes. Okay, because you want to be able to see where these variances are. So another wonderful thing about NetSuite is that when we're looking at it, so this is our balance sheet. Okay, and what we see here is, so this is our current amount here, okay, as of October 15, and then our comparison amount as of last year, okay, December 14, the fiscal period end. And then we have our variance, and it gives us our variance as a percentage. So the great thing is that any vertical analysis has already been completed for you here within NetSuite. Okay, so it takes away having to do that offline in Excel yourself. So it's such a wonderful savings of time for you that it really just increases the value of this ERP system. Okay, you don't have to sit there and manually enter the formulas or figure out the formulas to do so. But regardless, so the point is that having this comparability allows you to start to just dissect this information. So if you're responsible for downloading or extracting this information and preparing it for management, you can right away start to look at the things that kind of could use reviewing. So what I would look at within your asset section, what's going to be important. Where are we going down? Where do we see a negative variance? So we see our savings has a negative variance of 276%. So we went down in savings $870,000. If we use the savings for investing purposes, then that is fantastic. If we know that our investing didn't go up, then this would probably be something that's alarming. Did the company have to dip into savings in order to facilitate operations? Because if that's the case, that's a signal that the company might be in trouble in terms of their cash management. Okay, so that's obviously another, that could be a whole course in itself, but just to show you how you can use this type of analysis to start your forensic look at what's going on in the company. Okay, so this would stick out to you. Inventory has gone up 2,000%. Okay, so I would question, did we really need to jump from 587,000 to $12 million in inventory? Obviously, this is our test account, so the numbers are going to be exaggerated. But just so that you understand again, that's the value of performing the vertical analysis, is that when you get these variances in dollars or in percentages, it allows those things that look like anomalies, those things that look a little bit out of place, to become easily identified and for you to review and bring to whomever's attention, right? So I would call out, prepaid expenses here that have gone down 214%. That's a big swing to go from a credit to a positive, which is normal because a prepaid should be positive. So, did something happen that was an error at the end of last period that we had negative prepaid expenses, right? 57,000 percent increase in furniture and fixtures, which could possibly explain what happened to our savings, right? So this is how you kind of get to use these variances and the financial statements together to try to put together the pieces of the puzzle. And in my opinion, that's what accounting is. It's trying to figure out what's happened, and sometimes you can just use the financial statements yourself to answer these questions for you, and then just get validation from the account owners themselves. So I would look at it as a whole. Our other current assets have gone up, our total fixed assets has actually gone down, and then you would perform the same type of look in the liability section. Definitely an 887% increase in liabilities that has been received and not billed. It's something that I would pay attention to. Is this money, we've received the goods, but we haven't been billed for it? So, what's the hold up on the end of the vendors? We don't want to get stuck with billings, at a point in time in the year where we need our cash on hand. So this is a good way to flag out and maybe reach out to your vendors and say, listen, billings are not being consistent, and we don't want to end up in a situation where we have cash concerns. Fix whatever's going on your end. Sales taxes payable, nothing alarming there. So again, you would just kind of look at these percentages to see what really strikes you as peculiar, as needing more investigation, and what you need to raise in awareness to management. This is a great one. I think every company would love to see a 12,000% increase in their net income. But that's a great way for you to be the champion in your company, to get a bonus for you and your fellow associates. But so just I wanted to briefly show you how we have this available within our ERP system here, and how this information is used, and how you would go through it line by line. And that's exactly what management would do once the fiscal periods are closed. You sit together in a management meeting and you go through the financials line by line, and each department head responsible speaks to the variances, speaks to the reasons for the decreases and increases and the challenges that are causing it. And then, it doesn't end there, and then it turns into, the strategies. Okay, so this is what happened in this month. We had to use more cash than we expected. What are we going to change in the next period to make sure that these variances turn around? Okay, so that's how we use this level of analysis to improve business operations, but to increase the quality level of the information that we're taking out of the ERP system. And if we just looked at a basic financial statement in Excel, okay, so what I did was, here's a 2014 balance sheet, and here's a 2015. Okay, so applying the vertical analysis, I only focused on that one for this one. So we see where we were last year. Okay, our total current assets were 64% of our total assets. Our total current liabilities were 24% of our total liabilities known as equity, etc. And then we have all the percentages for each line item. Okay, so what you would do is, okay, this is where we were in 2014. Now let's look at where we are in 2015. You could very easily just compare, looking at it visually in this manner. Okay, we were 10, we were 11, and now we're 10. But I think that the greatest value is to always have your year-over-year change column. Okay, so if you're ever asked to prepare any type of comparative data, whether it's a vendor account balance listing or rebates listing or cash anything, anytime you're ever asked to provide a comparative report between one period and the next, always include the year-over-year change. percentage, or as we just saw in the ERP, with dollars or both, whatever the preference is for you, whatever the preference is for your management team, always included, because it avoids you from having to have anyone do calculations and you skip that part and you go straight to the who, what, when, where, why, and how do we fix it. And that is really where you're going to shine, and you're going to really, make an impression. Okay, leave the technical part out of your meetings, leave the technical part out of your discussions. Nobody wants to waste time seeing that or doing that. Okay, they want to hear the plans. Okay, everyone is limited for time. They want to be go, go, go. So you have everything ready to go for them, and you impress them with your ability to explain, what's happened and what we can change. Okay, so by looking at these percentages, we see that year over year, our total current assets have gone down, our total fixed assets have gone up, our total current liabilities have gone up. It's a small change. If your liabilities were going up 5, 10, 15, 20%, then you know that there's potentially a problem there. If your liabilities are going up and your assets are going down, it means you're using more debt to finance and operate the company, which is a huge concern for company, because it means that you might not have the cash on hand to meet your short-term or even your long-term obligations, and you might end up in a situation where the company is no longer able to sustain and support itself. Okay, so that's the huge value of looking at this data, and that's why we look at this data, to ensure that we don't end up in that type of a situation. So again, here there's nothing really alarming, but I just wanted to show you, in a simplified Excel version, how you would look at or prepare a reporting like this. So it's really just a matter of extracting the periods, putting them together in a consolidated spreadsheet, and then creating the year-over-year change as a percentage or in dollars, and then from there, beginning your fact-finding mission. If I were, responsible for preparing this type of report for management, hopefully I would be able to do this in a quick and efficient time, and I would give myself a buffer between the date of completion of this report and my meeting to go and maybe get some background information, talk to accounts payable, and see if there's anything that we need to know. Why have our accrued liabilities gone up? I would give them kudos for the fact that accounts payable actually went down from one period to the next. So that's really the intent, okay, with teaching you guys or talking to you guys about vertical analysis. It's being able to elevate, your reporting skills, and being able to elevate yourself in the business world when you're in meetings and when you're in discussions, and to adding that next level, that next level of interpretation and analysis. So that was the goal for us to include this content into your studies, and hopefully you see the value and it makes good sense, and hopefully you get the chance in real life to be able to apply these types of skills. And the more you get used to it, the more you get used to becoming a problem solving type thinker, versus here's the data you wanted and then walking away from it. Then that will kind of stagnate your career. Okay, being able to take information and being able to take it and run with it and find solutions and present that to management is really what's going to separate you from the next guy, the guy or girl who's willing to go to the next level for the company. That's what's really going to make you stick out from the next person. So hopefully, this, as you get introduced to it and you have a little bit more hands-on practice with it, it makes better sense to you, and you really get to see the value. All right, guys, thank you.